Welcome, ladies and gentlemen, to the Ask ServiceMonster show, where you've got questions for your service business, and we've got your answers. Today's question comes from Robbie. I know a lot of you guys are thinking about the same thing because I'm seeing it on bulletin boards and forums all over the place. What's up with a new tax law? But before we dive too deep into that, we're going to talk about formation, company formations. What's all this sole proprietorship, LLC, and C-Corp stuff really mean? Okay, first of all, disclaimer, I am not a CPA nor a tax attorney. So don't come crying back to me when you do something based off some YouTube video that has a different expectation than what you're thinking. Go talk to your CPA, go talk to your business attorney. Now, I'm pretty versed in this stuff. I know it fairly well, but even every once in a while, I come across some new information. So we went really deep here. We took a long time researching and listening to other people. I talked to our CPA. I had a couple questions for him, got those answered, and we're hoping to present you here with a pretty comprehensive piece. Okay, so first off, company formations. You have a number of ways that you can start your business, and most of you guys have already filed one or another. So let's talk about the breakdown. Normally, I'll do this in kind of an escalating form from sole proprietorship all the way up to C-Corp. But this time I want to break it down chronologically. What did we have and what did we need to add and why? I think the context is pretty important. With the ratification of the 16th Amendment, Senate and Congress had deemed itself worthy to collect taxes on us citizens. And so obviously we had personal taxes, but we also had this corporate entity, this corporate structure. Corporations were needed to establish some sort of a different entity that could move money around. Banks were a big part of the first corporate front. Now, if you just want to start a business, you don't have to be a big corporation. You can be a sole proprietorship, or if you put a couple guys together, a partnership. Current tax law has both sole proprietorships and partnerships as a pretty flexible entity, but there's no liability protection. If someone sues your business, then they could theoretically go after your personal assets. So your house, your cars, your bank account, and that's a really bad thing, right? So corporations were established to create that separation, or what we now call the corporate veil. The ability of someone to sue the company will not transcend to the ownership. Now, C-Corps were actually originally established around the 1700s in the United States, right? They were already a thing in a handful of countries around the world. United States C-Corps are pretty inflexible. You have to follow a certain set of rules set by the federal and state governments, and you have to create a series of bylaws which dictate how you're going to operate the business. The trick with C-Corps under our current and past laws is it's known as a double taxation entity. The profits that come out of the C-Corp, those are going to be taxed. And then the owners that take dividends and payments as employees, that gets taxed at your personal income level. And so those funds actually end up being taxed twice. Stock is rather interesting in a C-Corp in that they can break it up into two types. Common, which is voting stock, and preferred, non-voting. This is how the whole stock market works, right? You can buy shares, but those shares are preferred shares. You have no real voting rights within the company. Okay, so you can see I've got a partnership or sole proprietorship, or I've got a C-Corp. And at that point in time, that was the only two choices. But in the 1950s, Congress established the S-Corporation. Now, this is a little different. It is considered pass-through taxation, like a sole proprietorship or partnership, but you've got some liability protection. You also have to adhere to a certain set of rules, but you get to avoid the double taxation. Some of the big differences include the cap. You can only have up to 100 owners within an S-Corp. They all have to be U.S. citizens, and you only get one class of stock, voting shares. A big difference between an S-Corp and C-Corp, and then a sole proprietorship in LLC, is how you're treated as an employee. Now, in the 1990s, Congress created yet another structure known as the LLC. Now, the interesting thing here is from a tax point of view, there's no such thing. As an LLC, you're either going to file as a sole proprietorship or partnership, or you're going to file as an S-Corp. Or, as I recently find out, you can actually file as a C-Corp as well. They're pretty flexible in that regard. But if it walks like a duck and talks like a duck and it taxes like a duck, you've got to act like a duck. Meaning that if you want to be an LLC, filing as S-Corp, you have to file S-Corp rules and bylaws structure. All right, with some of those basic changes, really doesn't mean much. It's not tangible. So let's take a look at some numbers and how this really affects your bottom line and how much cash you take home. All right, so I'm going to take a look at some of this. I'm going to put a little thing up here. You can see sole proprietor, right? We're going to take your income here at $150,000. We're going to say that you've got $50,000 in expenses. Now, obviously, these are just rough numbers to get the point across, but we're going to play apples to apples with each of these corporate structures and taxation entities so you can see how the math plays out. Your profit for the sole proprietorship here is $100K, and since there's complete pass-through taxation, that's direct income to you. There's no corporate entity at all. You are the business, right? And so that means your personal taxable income comes in at $100,000. That's bad news. FICA, or what we know as self-employment tax, comes in at 15.3%. And so that means you're going to be paying $15,300 in self-employment taxes on that $100,000 from the business. Now you take a look at your total taxable income of $100,000. Now that is what's going to be taxed at your local, state, and federal levels as far as income goes. Company cash out, which is interesting, how much cash do you have on hand minus the company and corporate taxation? In this case, we're taking into account that FICA. And what we're looking at is $84,700 in cash. That's what you're going to have before the obligation of tax for your state and federal taxes. All right, moving on to the C-Corp. Again, $150,000 in income, $50,000 in expenses, leaves you $100,000 in profit. So what we're going to do, though, is you're going to take a salary here of $30,000. This is going to be a big difference. The company then nets, because you are an expense as a C-Corp, as an employee, the company then nets $70,000. So here's where things get interesting. Your personal income, right, at this stage is $30,000. And that's what you're going to pay your self-employment taxes on. So in this case, you're spending $4,500 as opposed to the $15,000 when we were filing as a sole proprietor. Again, your total taxable income is still going to be that $100,000. So your state and federal taxes will be calculated based off that. But your cash in hand in this case, because of the much lower FICA rate, is $95,000. Big difference. Okay, moving on to C-Corp. We have $150,000 income, $50,000 expenses. Again, the company here profits at $100K. We're going to do the same thing here, take a $30,000 salary, which leaves the company net at $70,000. Okay, so at this point, the C-Corp gets taxed, right? It gets taxed on that $70,000, and it's taxed at 20%. And so we're looking at $14,000 straight off the top. So that cash just goes to the government. We're going to say that our personal income here obviously was that salary of $30,000, which we're paying our self-employment rate, and we're paying the same as we were as a S-Corp at $4,500. And this actually calculates out to an $86,000 taxable income. So this is what your state and federal income taxes will be based off of. But look at your company cash out, because you had to pay that corporate tax rate. You only took out $81K. And now you're still on the hook for $86,000 in taxable liability. Now let's talk about changes to the new law that may have affected this. And there's a handful of changes that were made, and we'll go over them in a second, but I really want to focus on the different types. Okay. The tax law is about 500 pages long, and I went through a handful of questions from other attorneys, and I saw other content that was created as a result of these guys from experts. And what they're saying is it breaks down into 3 buckets. You've got a personal, a small business, and a large business bucket. Now the personal stuff, I'm not going to worry about. Okay, it sunsets in 8 years. That's going to calculate however it calculates. The small business is where we're going to focus. But just keeping in mind that most of these, if not all of these general rules that I'm about to go over apply to all corporate structures. So the good. There is a standard now 20% deduction of the profit off the top for your taxable income. And we'll go over the numbers there in a second, but that's kind of the big win. For you service providers, the auto deduction also went up quite a bit. 179 deductions went from $500,000 to $1 million, which is considerable. Now the 179 is your ability to immediately depreciate an asset. You see, we didn't used to be able to do this, buy something for $100 and then expense it for $100 at the end of the tax season. If it was a depreciable asset, let's say over 3 years, it's $33 a year, we could only expense $33 of that asset each year for a 3-year period. Made it really tough. You would buy a big piece of equipment, but yet you couldn't realize the expenses until somewhere down the road. That's where the 179 came in. They focused on small businesses by making it a $500,000 cap, but the new tax law just increased that to $1 million. Computers are now extended as well, so if you have internal computer equipment in any real scale, you're going to get a bump out of this as well. Okay, the bad. So entertainment expenses, yeah, they're no longer a thing. You can still do travel and food reasonably, but if you go golfing to close a deal, yeah, that golf game, you can't expense that anymore. Not that it matters for you guys, but lobbying is now no longer an expense. And, sad face, you can no longer write off 100% of the expenses for food served inside your facility. Bummer for us. Every month, we cater lunch inside ServiceMonster. And so we were being able to expense that 100% because we were bringing the food here. Now, it's just like everything else, and it's a 50% deduction. So let's go over that 20% deduction off of your profit. So if you take a look at the numbers here, and we're going to put this up in context of the example we just gave, you can see we added a new line, and it's the new tax law 20%. And the deal here is that you take the company's profit and you just take 20% off of that straight off the top. That's pretty good. It gives us a lot of growth opportunities and flexibility, but let's see how the numbers play out. We'll take a look at the sole proprietorship first, and you can see everything is as it was, with the exception of this new line. The new tax law allows you to deduct 20% of your profit. So in this case, we're looking at a new total taxable income of $80,000. Now the cash home, taking the cash out, that stays the same. So we're $84K here. We're going to tax state and federal level here at $80K. The S-Corp, a little less dramatic in that the company net was only 70 grand, not the 100 that the sole proprietor realized. But we still can deduct $14,000 straight off the top. That gives us a taxable income of $86,000. And then looking at C-Corp, again, same thing. In this case, it's the same $14,000. Again, your cash on hand is $81K, and your taxable income at this point is the $86,000. Okay, guys, 3 points I want to make here at the end. Again, you want to check with your accountant, your CPA, and your tax attorney. You know, this is really bro-trepreneur science. I don't have a degree in this stuff. I'm just trying to help you get an understanding of the playing field. Number 2, for most companies, especially small service providers, S-Corp for the win. If you're an LLC, filing S-Corp is a great idea. One point I do want to point out is I mentioned that you can switch. You can, but it's every 5 years. And then my third tip here is if you're pushing around big money, you want to watch for those taxable events that could spill over into the personal side of your taxes. That's why C-Corps are effective. When you have tens of millions that you're moving around, creating a taxable event on your personal taxes is some big numbers, and that can get scary. So those C-Corps will shield you from that happening. From everyone here at ServiceMonster, thank you so much for your attention. Subscribe to our YouTube channel, go check out the demo, and give us a call.